Hello, good morning. You've tuned into Trading Hour, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, and with me is Hormaz Pataki as well. Hormaz, very good morning to you. We were expecting a better morning so far, even now, but let's not forget it's Nifty expiry as well, monthly expiry. So volatility is the name of the game, and today taco. That's the name of the game as well. I hope we do get some tacos to eat as well, is what I'm watching out for.
I just asked the PCR for some tacos if we can.
By the end of the show, I hope we're getting that then. But today, Nifty flip-flopping between the red and the green, 24,750 as of now.
Blame it on the expiry, right? And that's what has been happening. Even the good news is not being appreciated here by the street. We did open higher though, but we have come off significantly from the highs of the day, almost giving up all the gains that we have had. And this despite the Dow futures trading with gains of 600 points as we speak. So the Wall Street is cheering the announcements that were made by the US Trade Court overnight, but that is not being reflected in our own markets. Of course, banks are the principal culprits here, 150 points down on the Nifty bank. So that is also weighing in on the sentiments. And as you can see some flashes on your screen, the RBI has released its annual report for FY25. We'll get you more details on that as well over the course of the show. But for now, the index has given up the gains. The broader markets too have given up their gains from the morning. So it's a fairly choppy start to the trading session. And of course, you can't not ignore the earnings reactions that are coming in today. Wellspun Corp among the top gainers on the Nifty 500, 8.5% higher on that stock after a strong result performance coming in for the fourth quarter. And MMTC too, 12% higher, building on to gains from yesterday, mind you. So 12% higher on MMTC. That's doing fairly well for itself as well. So good going for some of these earnings names. But the stock of the morning that we've been speaking about, and it was a big development that came in last evening, and that is IndusInd Bank. And that is after the Securities and Exchange Board of India, or the market regulator SEBI, has passed an interim order in the high-profile insider trading case involving key managerial personnel of the lender, including the bank's former CEO and other senior executives. Now, the regulator has barred all of these 5 individuals from buying or selling securities and has also frozen their bank accounts. Ritu is here to give us more details on this. Ritu.
Well, Hormaz, as you said, it is a damning order, against the 5 senior executives, and that includes the former CEO Sumant Katpalia and former Deputy CEO Arun Khurana in this insider trading case. The regulators found essentially that these individuals sold shares of the bank while they were in possession of unpublished price-sensitive information and thereby avoided losses of nearly 20 crore rupees. In this interim order, SEBI has frozen their bank and demat accounts to the extent of those gains. It has barred them from trading in securities until further notice and asked them to submit a full inventory of all of their assets. Collectively, the order shows that these individuals avoided losses of 19.78 crore rupees, out of which 14.4 crores was by Arun Khurana alone and about 5.2 crores by Sumant Katpalia. The others that have been named in this order for alleged insider trading are Sushant Saurabh, who is the head of Treasury Operations, Rohan Jatanna, the Senior Vice President of Global Markets, and picture this, Anil Rao, the Chief Administrative Officer, who is also part of the 2-member executive committee approved by the RBI currently running the bank in the absence of a new CEO. Now, SEBI's investigation shows that these people were aware of the discrepancies a good 15 months before they made this disclosure. And not only their internal team, even the external auditor KPMG had flagged this impact long before. Sumant Katpalia, for instance, he alone sold about 1.25 lakh shares of IndusInd, while Arun Khurana offloaded 3.5 lakh shares without making a single new share purchase in the period between December of 2023. That is when the management first found out about the discrepancies, and March of 2025 when the information was made public. Now, beyond these 5 executives, SEBI said it is still investigating other suspects that it did not name. So, questions are already, of course, swirling around the board's oversight, the auditor's role, and importantly, Anil Rao being part of the 2-member executive committee, whether we will see that committee getting revamped and the repercussions that he would have to face. Now, with the CEO and the deputy CEO already out of the picture, the story is still far from over, and more heads may roll if the insider trading charges stick.
Okay, Ritu, thank you so much for that. And on that note, we had Amit Tandon earlier on the day as well. And he was talking about these issues coming in and discussing more on, the IndusInd prospect going forward as well, especially after this order that has come in. Listen to that conversation.
If you read what SEBI said, SEBI said that, look, we've appointed KPMG on the basis of a board note. So again, you have to ask whether the board were shielding the management or whether they were taken by surprise. I think that is really not clear at this stage, and we'll need to hear a little bit more. So if there is action against the board, you can expect that there is going to be some more tumultuous times going ahead. It's clear that the board has not lived up to what RBI's expectations were and what the investors' expectations were. So I think we are going to be in for some amount of volatility or internal churn as far as the bank is concerned. Likely to be a shakeout as far as the board is concerned. There is, of course, the existing board structure, existing management structure or the leadership structure will change. So the question is, how quickly will they be able to bring in a new CEO? And that in itself will mean there's going to be a round of internal cleaning up. Every bank is going to become much, much more internal focused rather than looking at opportunities out in the market. So I think there's going to be some degree of slowdown as far as this bank operations are concerned.
So important conversation there on IndusInd Bank. The stock, though, has not seen much of a reaction to that, and it's almost a hope trade now that the clean-out process has begun, things will start to normalize for IndusInd Bank, and it's showing up on the screen as well, 1.25% higher for IndusInd Bank. The stock is now up 35% from its 52-week low of 566 that the stock had fallen to, or 606, I beg your pardon, that the stock had fallen to after the first instance of the derivative accounting issue had come out. So IndusInd Bank there for you. By the way, the flashes of the RBI annual report on your screen. The global economic outlook for 2025 and 26 remains clouded by multiple challenges. The RBI annual report also talks of the fact that there are elevated debt, public debt across several economies, and that has been a subject of the conversation as well, particularly in the US. The pace of disinflation is losing momentum. Challenges also include trade tensions, financial market volatility, climate shocks. So a lot of issues being addressed in the RBI annual report. We'll talk more about this as the show goes by as well. But from the broader markets, the earnings reactions continue. As we just mentioned earlier, Insecticides India and Bharat Rasayan are two of them, and both of them are seeing reactions at the opposite ends of the spectrum. Rhea has the fine print for both of these shares. Rhea.
We've got two earnings candidates in focus today, both Insecticides India and Bharat Rasayan. First, focusing on Insecticides India, the revenue growth has come in at around 2% for FY25, below the guided range of 3 to 4%, with a volume growth at around 10% and a price decline of 8% in this year. EBITDA margins, however, have remained strong at around 11%, in line with the company's guidance of double-digit margins. Gross margins have also seen a jump up of around 650 basis points in this year, which was led by a better product mix, improved pricing strategy, and as well as the new launches that were taken by the company this year. Overall, the profit growth has been led by an increased focus on the value-added premium products, which have seen a growth of around 13% in this year. Going forward, the company has said that their growth outlook remains intact. They're expecting an expansion in the premium products, stable gross profit margins, as well as a further improvement in the EBITDA margins as well. For the newly launched herbicide called Altair, they are expecting to generate around 10 to 15 crores of revenue initially, with the revenue going up to around 40 to 50 crores in the subsequent year as well. So overall, healthy set for Insecticides India, and the street is reacting positively to that. On the flip side, Bharat Rasayan has posted a very weak set of numbers in this quarter. The full year performance, though, has remained largely healthy, but quarter 4 has disappointed by a lot. Revenue growth has remained flat in this quarter. Profitability has been sharply lower. EBITDA and net profit have seen declines of around 42% and 62% respectively, both on a year-on-year basis. And margins, EBITDA margins, have also seen a very steep cut of around 925 basis points. So the street has been reacting negatively to that. Stock down around 8% on the back of this.
Thank you so much for that, Priya. But a quick look at what these other stocks are doing in today's trading session. We have Zentek, that's coming back in action as well. As of now, is up 5% in the trading session. Obviously, this is one of those companies that makes drones, and during the run-up that we saw in the defense stock, Zentek was one of them that saw a run-up. ITI Limited, they reported their numbers, and yesterday we had already seen a run-up. Today also that's continued, so surely good set of numbers from ITI is keeping the stock a buzz. Let's also look at, Castrol India, that's buzzing in trade today, 5% gain on that front. Vari Energies are some of the gainers that are coming in. And other than that, overall, from the broader end of the market, we're seeing a lot more performance coming in because of the earnings reaction that we're seeing for some of the companies. And Ria mentioned a few of them as well. But let's talk about Cummins India, because that's also buzzing away in trade, almost trading at the day's highest point. And this is after its Q4 numbers, but also commentary came in from their con call that was just there a short while ago. Vamakshi is joining in with us to give us the latest on this front. Vamakshi, what were the key highlights coming in from the earnings as well as the con call?
Well, absolutely. When it was a good set of numbers that came through from the company. Of course, revenue came in much lower as compared to what the street was expecting, largely led by the miss on the domestic front, but the exports business for the company did quite well. That saw an uptick of almost 39% on a year-on-year basis. Largely, when you look at the operational numbers, they came in much better than anticipated. Keep in mind that in the same quarter last year, there was a one-time gain. Therefore, the margins looked higher last year, and we were expecting a significant contraction this time around in the margins, but that has not really panned out. The contraction in margins is not as worse as one would have expected. The net profit, though, has seen a downtick of almost 7%, and largely this is the number for the net profit has come in much better than what the street was anticipating. The con call actually just concluded just a couple of minutes ago, and the management said that they are anticipating double-digit revenue growth to continue in FY26 as well. They endeavor to sustain as well as slightly improve the margins. This is the gross margins that I'm talking about in FY26. However, they are cautiously optimistic on their demand outlook. Keep in mind that they have said that the pricing could take 1 to 2 quarters to settle completely, and the competitive intensity out here has picked up, but largely they have been able to hold on to their prices, which bodes well from a margin perspective. Capex will be in the same range as seen in FY25. So largely that those were some of the important takeaways that have come through from the con call. Resultantly, the stock is trading higher.
Well, the street likes what the management has said in the earnings call. The stock had surged to the highest point of the day at Cummins India, almost 6% higher now on the stock. Vamakshi, thanks a lot for that. By the way, the index has cooled off further from the highs of the day. But we take a short break. On the other side, we get you all things commodities with Manisha Gupta. Welcome back. Well, the index has cooled off significantly from the highs of the day, and now it's into the red. Now 20 points down on the Sensex at 24,730 now is where we stand, and that is in comparison to the highs of the day of 24,889. So almost 160 point downtick from the highs of the day is what the Nifty has seen. The monthly expiry for the index today, and that seems to be weighing in on the sentiments on the Lal Street as of now, because the Dow futures continue to remain where they are, 600 points higher for the Dow futures. The US dollar has staged a rebound. It's above the mark of 100. Crude oil prices too have seen a rebound. Brent is now heading towards $66 a barrel. We'll talk more about that as the day goes by. But on to earnings conversations. Then GIC Re reported its fourth quarter numbers, and we are now being joined by Mr. Ramaswamy Narayanan, who is the chairman and managing director at the company. Mr. Narayanan, good morning. Thank you so much for joining in. Your gross premiums for the quarter grew by 10%, and your net earned premiums were also up 9%. Now, what are you penciling in for FY26 when it comes to both these aspects, both the gross premium and the net earned premium as well?
So typically we would be looking for about 10% growth going forward, and simply because we are planning to grow both our domestic and international business. The international business for last year, actually we had degrown, and honestly in the last maybe 2-3 years we have been kind of consolidating our book. Our growth journey started last year. Last year we grew by about 10.72% year on year. So last year in October, we got our credit rating upgraded. We, for writing international business, you need to have a good international credit rating. So currently AM Best has rated us A- excellent, which allows us to really look at and get to see good quality international business. So 1st Jan, when the international business normally renews, we got to see a lot of good business from the market, and we wrote about 28% more. And the revenue for that will come in 25-26. Similarly, in 1st April 25, when the Indian market renewed, we grew there by about 8%. So overall, we expect to grow by about 10% in this year.
Right, sir. Good morning. This is Vinny joining in the conversation as well. What I want to also understand is in terms of your underwriting loss. There's a loss this time of around 224 crore rupees in Q4 versus a profit of 490 crores. What has led to that? One, is that a one-off that is coming in? Or maybe possible that this could see an impact in Q1, FY26, Q2 as well?
Vinny, hi, good morning. Again, this is something that I've been telling analysts, the last couple of years, that unlike, I understand that, the financial markets and analysts tend to look at quarter-on-quarter figures. But then for our industry, whether it is insurance or reinsurance, honestly, I don't think it makes sense. Simply because, you could get a catastrophe in one quarter, which was not there the previous year. It would have happened in a different quarter. So suddenly some quarters look good, some do not look so good. So coming back to our performance, if I were to look at it from an annual perspective, we've actually done very well. Last year around the same time in April, when people had asked me what we were proposing to do, I said after 3 years of consolidation, we are growing now. So we would grow 10%. But actually, we have done better. We've grown by about 10.72% for 24-25. We also said that we will be striving to remove or shave off 2% from our combined ratio every year. Now, this year, we've actually done better. We've shaved off 3%. From 111, we have come down to 108. And our loss ratios have come down by 4%. Our profit before tax is at 8,650 crores, which is, a record for this company. In its 53 years, it has never touched this kind of figures. So we are very sanguine about what we are doing, the underwriting that we are doing, and how we are, essentially trying to ensure that the business that we are writing are profitable. Coming back to your question about Q4, what happened there? Simple. We write international business, so obviously we also write US. It's a big market. Now, if you see in the first week of Jan, the Los Angeles suffered the wildfire attacks, and obviously there were losses there. And we have got some losses, and the initial figures that we have got from our business partners, it's around $38 million. Currently, we haven't paid anything. This is all outstanding. But our actuaries also felt that, going forward, we should ensure that there are no shocks to the balance sheet from these losses. So we've actually provided for about $150 million for these losses. So that is one thing which has kind of caused a dip in the Q4. Second is again on provisioning of life business. Life, as you can make out, is a long-tailed business, goes over 20, 25, 30 years. And some of the business that we wrote about 10 years back, the loss ratios went up in the last couple of years. It could be due to COVID or something else. Based on that, we felt that the provisioning must improve, so we have improved it. So honestly, I think the loss ratios have been well under control. It's just that we have been more conservative and we have provided more. So honestly, I would say Q4 is a one-off. We will not see those losses in Q1 of this year.
Now, Mr. Narayanan, since you mentioned the combined ratio, you brought it down from 111 to 108. Do you go below 105 in FY26?
Well, we will definitely try to do that. But last year, I had made a similar advisory, I would say, when somebody asked what is the glide path, how or when would you reach 100%? I had said it's not a one-year thing. We will need to do it over a period of years. And we had typically said 2% each year for the first 3 years and then about 1% for the rest of the next 4 years. I still stick with that. I would say this year also we will be looking to cut down by 2% for the next couple of years and then come closer to 100%.
How big is the US market for you, Mr. Narayanan? You just mentioned that there were losses that you saw in the fourth quarter. How big is your international business? If you could give us a mix as well. And within that, the US exposure as well.
So currently, if you see my international domestic mix is 25-75. 25 is international, 75 is domestic. That's simply because, in the last 2-3 years when my credit rating was not up there, we've not been able to write international book as much as we want to. Like typically any reinsurer, we would want to spread our bets, not have too much in one country. So obviously our desire is to have international to domestic at 50-50 at some point of time. It will take some time simply because, some of the international markets, economies are not doing well. So I don't expect to grow too much there. Whereas the Indian economy is actually doing so well that you see a lot of opportunities to grow. Having said that, there are a few markets that we will try. Obviously, US and Japan are two markets that we are looking to. Japan simply because they value long-term relationships. They're also very security conscious. So we used to write a lot of business there. We paid a lot of their losses. And when due to the credit rating going down, when we had to step back, we knew that the relationship is still there. We've already started talking to them. So that is a market we will write. It will still not reach the levels that we were before the downgrade, but we will slowly increase that. Similarly, US is one market. It's a big market. So obviously, we will look to write business there. It's a difficult market to write simply because compliances are difficult. What we do is we write business in head office from the US. We also use our Lloyd syndicate to write business there. Because when I write from the head office, I need to provide collaterals, which becomes difficult for us.
Okay. Sir, a quick one. I just wanted to know in terms of your fire as well as the motor side of your insurance, which accounts for almost 54% of the gross written premium. The performance there has improved. What is the expectation for FY26? And in terms of pricing, some analysts are highlighting better pricing. Is that something we're watching out for here?
Yes, definitely. So again, property, of course, we write both in the international market and here. And we are seeing pricing improving in both places. In India, honestly, we have been pushing the insurance companies to ensure that the direct market pricing that they do is definitely better, because otherwise this market becomes unviable. So that is something that we have been doing for the market, trying to tell companies how they should price, how they should manage their exposures, overall how they should ensure that the property portfolio remains profitable. So that we will continue to do, and we are very confident about the property portfolio. On the motor side, we write it only majorly in India. Very rarely do we write motor internationally because compliances can be difficult. It's a long tail class. So obviously we need to end up putting more capital there, which we don't want to do. So to come back to your point, yes, we expect property and motor to do better. It will of course depend on what catastrophes India face, because typically any floods happen, the first casualty is motor.
All right, Mr. Narayanan, thank you so much for sparing time and joining us on this insightful conversation. Wish you good luck for the rest of the year as well, the management of GIC Re. Shifting focus now to the commodity space, Manisha Gupta joining in. And since it is a sweet day for most of the global equity markets, we are focusing on sugar, Manisha.
Oh, well, yes, that is because the sugar prices also have continued to decline. When you look at the global markets, the New York sugar prices are trading at a 4-year lows, and the London sugar prices have declined to 4.5-month lows as well. This is after the US Department of Agriculture says that this time around for 2025-26, we are looking at a global sugar production at a record number of around 189 million tons. They also anticipate that the global surplus could be as high as 41 million tons as well. For the Indian markets as well, while the current season has seen sugar production less than 30 million tons, but the next season, 25-26, the sowing has been great, the monsoon expected above normal as well, and the anticipation is that we could be looking at 34 million tons of sugar production therein. Also, the Indian sugar demand has seen a bit of a decline from beverages, from cold drinks, from ice creams as well, because it's not so much hot there and the monsoons have been early as well. So most of the FMCG reports do suggest that you could be looking at a slight decline in demand from there as well. These are the numbers that we've seen in sense of allocation of sugar from mills to sell into the open market. And as you can see, that allocation also has been slightly on the lower side for the month of June in 2025, less than last year and less than last month as well. And that really tells you that the demand is slightly on the weaker side there. The street also anticipates that going forward from here, you could be looking at higher sugar supplies and lesser production, or rather lesser demand going forward. That could continue to be onto the Indian prices as well.
Okay, that's a word coming in on sugar. Thank you so much for that, Manisha. But on that note, we're going to slip into a very short break. And as we go to the break, we're excited to unveil our brand new global business news channel. The all-new CNBC-TV18 Prime brings you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m. Welcome back to Trading Hour on CNBC-TV18. Nifty as of now is almost trading at the day's lowest point. 24,720 levels is what it's trading at. But let's talk about Bajaj Auto because that's expected to report its numbers today. What are we watching out for this time from the company in Q4 FY25? Sudarshan is joining in with us to give us those expectations. Good morning, Sudarshan.
Good morning. So for Bajaj Auto, we are expecting a steady set of earnings. Higher volumes will support revenue, while better product mix will aid realization. Also, margin is expected to hold the levels above 20%. Talk about the headline numbers. Profit is seen rising 3%, may come in at rupees 2,002 crore. Revenue too can increase by 4%. EBITDA may increase by 4%, can come in at rupees 2,406 crore. And margin may hold about 20%. It may come in at 20.1%, same as the Q4 of FY24. Volumes were higher 4% year-on-year and down 10% sequentially. Realization can increase 1% year-on-year. Also, on a sequential basis, it may increase by 4%. So overall, we are expecting a steady set of earnings from Bajaj Auto. What will be watching out for in the commentary? First, what exactly company talks about a PLI benefits, and also domestic outlook if there is a major recovery that company is saying, especially in the rural segment. Also, what would be the most important is the recovery in exports and especially the Nigerian market. So these are the things, some of the things that we'll be watching out for the commentary. But overall, steady set of earnings expected.
Some much awaited results from Bajaj Auto. Sudarshan, thanks a lot for that. Generally coming after market hours, so it'll be interesting to see what Bajaj Auto has to deliver. The stock, though, significantly down from the highs that it had made, which were well in excess of 12,000 rupees. We keep an eye out on Bajaj Auto, 10% higher in the last 1 month. But time for a quick chart check then. Sudeep Shah from SBI Securities is now joining in. Sudeep, good morning. Thank you for joining in. Expiry-related volatility, if you could call it that, because despite positive global cues, you're still not seeing any move towards that 25,000 mark. What are the charts indicating here on the Nifty? Do we grind lower from here? And what are your stock recommendations for the morning?
Yeah, good morning, Hormaz. Yeah, you can call it expiry-related volatility because see, what's happening is that even post-opening, initially 24,800 seemed difficult to hold, and now sustaining below that, indices are heading towards 24,680, 24,700. However, overall, what we feel is that the range of 24,600 to 24,900 by and large could still continue for the next few sessions. On the downside, this 24,600 zone is now acting as a strong support, being the 20-day exponential moving average. And in the last 4 to 5 weeks, there has been 1 or 2 times that this moving average has been retested, and we have seen a strong bounce back from that zone. So overall, 24,600 is the support zone that I feel, and about 24,900, 24,930 indices are good to go for 25,300, 25,500. From a stock specific perspective, I feel a lot of mid caps, a lot of select large caps are moving. And the first stock that is there on my radar is MCX. Now, most of these platform related stocks or exchange related stocks have been doing well of late in the last several weeks, and MCX has given a fresh breakout above 6,500, 6,480 zone, and now from here on the stock is it looks like the stock is headed towards 6,900, 7,000 zone on the upside, and this can be bought with a stop loss at 6,500 on the downside. The second stock that is there on our radar is Cummins India. Now here, after many weeks, we've seen some kind of a breakout in this chart. The stock has been in a range since last 4 to 5 months, right from the month of January, and it has broken out above 3,050, 3,080 zone, and that is also with strong volumes now. So here the stock is headed towards a recovery up to 3,400, 3,450 zone, and can be bought with a stop loss at 3,000.
Okay, Sudeep, thank you so much, for joining in with us, giving us a check in terms of the market as well as the stocks that you're looking at. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll be back with more news and updates, and we'll discuss the fundamentals with Madan Gopal Ramu of Sundaram Alternate Assets after the break.
Back with us here on Trading Hour. The Nifty continues to remain choppy on the day of its monthly expiry. Good time to get in Madan Gopal Ramu from Sundaram Alternate Assets, who's now joining in. Madan Gopal, good morning. Thank you for joining in. I just read your note where you mentioned that you continue to have a fairly higher exposure to the mid and small caps in comparison to a fairly street consensus of moving towards the large caps because they are the ones that now offer more value compared to the broader markets. If you could explain why is that so, and if the broader markets are set to do well, what happens to the large cap trade?
Right. Large caps, we feel the problem is on the earnings side. While the valuation, you can still argue that there are certain sectors because the earnings has been subdued, the valuation has also been moderate. But it's not that large caps are not costly. For the kind of almost like Q4, we saw the earnings growth of large caps were in single digit, even adjusted for financials. So we feel that large caps lack earnings growth. Even if you take a 2 to 3 year view, there are many sectors in large cap like banks and IT sector, FMCG, and even oil and gas. Together, they form almost like 60-70% of the Nifty. The earnings growth may not be in double digit. It will be in higher single digit. So we feel that if you want to make money in market, you can't be exposed to these traditional sectors. You have to move beyond the large caps. You are right. Mid caps valuations are looking higher, but it's looking higher because of the earnings growth in specific pockets being much, much better. And we feel comfortable in playing some of these segments. And even in Q4, segments like capital goods, NBFCs, even some of the spaces in healthcare have delivered quite a good earnings beat. So we feel that it's better to approach the market not as a capco basis, which is more traditional way of approaching the market. It's better to approach stock specific and sector specific and theme specific. And and there are segments within the market, even across the capcos, which are offering high double-digit sort of earnings growth. Even last year, when the overall Nifty's earnings growth was in single digit. So that's the reason that we remained with the mid and small cap during the correction, and we also added we made some sector rotations, but fairly remained more towards the mid and small cap space.
Okay, you've remained more towards the mid and small cap space. You've said that you've made some sector rotations as well. And right now also sector stocks is what one should look at more than just looking at large cap traditional side of investing. What sectors are you looking at then?
Capital goods, particularly the power equipment side of the capital goods, have given a major beat to the earnings, and also from the commentary point of view, given what is happening in India as well as globally. Power equipment side looks pretty good. Across the transmission, generation and distribution side, there is a lot of capex happening. If you look at recent grid stability issues that came in Europe, there is a lot more talk about the renewables mix in the grid, creating more opportunity for more transmission capex. If you see some of these, the equipment manufacturers, there are only 3 companies globally, excluding some of the Chinese players, who are capable of doing these transmission equipments. Even in India, if you see the HVDC projects, you see bidding only coming from Hitachi, GE, and Siemens. It clearly plays where competition is lower, opportunity is going up. At least for next 2-3 years, we see visibility of capex happening across transmission and generation, and the competition is limited in India as well as global as well. In India, particularly last decade, we saw Chinese competition being higher, which has come off now. And India is very clear on supporting the domestic manufacturing. So that is, if you see the margins of these companies, which were in single digit in the last decade, it has moved into almost a higher double digit, sort of higher teen sort of margins. In addition to it, you are seeing the order book almost growing 30-40% across these companies. So we feel that capital goods in power sector looks pretty interesting. At least next 2-3 years, the visibility is good. We also feel NBFCs, which has been always our structural call, and we feel that compared to banks, NBFCs are better positioned. But I'm very specific to the companies we are referring here. And growth has been pretty meaningful. Healthcare also looks pretty good. The rotation that we did was we booked some profits in e-commerce space, where we saw the earnings growth is getting cut right now, and we shifted them back to some of the capital goods names and financial space.
Okay. Madan, you highlighted a couple of points. One, in terms of power. Power is what you're talking about. You're expecting them to do well going forward. But do you expect across the board, so transmission, generation, as well as distribution, and which companies are you looking at? Because you're looking company specific also. So which companies in India are a better bet right now?
Obviously, I even mentioned these names. GE, Hitachi are listed names and pure play on transmission capex in India, and also they are getting opportunity to export right now. So we feel these companies. There has been a bit of a rally in these names, so investors can look for some sort of a correction to get in. But if you take a 3-year view, I think still they have quite a bit of growth left in them to support decent returns from these spaces. We would rather play capital goods, the entire power story in the early cycle, rather than playing the utilities. So that's the reason to highlight on the capital goods space within the power sector. We also like, with the recent correction that has happened in the cable space, like KA, Polycab, the valuations become reasonable, and the companies are looking at 20% sort of a growth. If you look at even the large cap, if you exclude the traditional sectors which generally trade low in terms of multiple, even growth part of the Nifty is trading at 25 times. So if you're getting, and growth part of the Nifty is around 15% sort of a number. But if you're getting mid-cap names at 20% plus sort of a growth with 25 times sort of a 1-year forward multiple, make a decent entry point for the investors with a 2 to 3 year view.
What about the oil marketing companies, Madan? Because there is a fair amount of chatter with regards to them in the oil and gas space. And when you mention oil and gas, these are the names that first come up, the HPBPs and the IOCs. Where, in terms of where are you positioned here? Would you prefer the OMCs in comparison to the ONGCs or the Oil Indias, or your preference is otherwise? Because in both cases, the dividend yield factor also comes into play as well.
No, actually, I mentioned that these are part of the Nifty which we are avoiding at this point, primarily because the earnings growth has not been pretty impressive. And we don't think, given the global noise around the slowdown, oil prices are not likely, oil demand particularly not likely to surprise you on the positive front. So we would stay away from it, and it's very difficult to track the global commodities, in our opinion. There could be some tactical opportunities sometime, but we have felt that taking a high conviction bet on these are very, very risky. So we have mostly avoided the oil companies in our portfolios.
You're avoiding these oil companies in your portfolios. Madan, quick question, right? You said you do like healthcare space as well. Is it only healthcare or even some of these pharma companies? Because you have a lot of commentary that keeps coming in on tariff front. Today also we did have some updates coming in. So is there something like, you would look at global pharma companies, CDMOs? What are you looking at there?
Within healthcare space, we have hospitals, and that's a very specific call on one of the hospital names, which is going through a merger now with and thereby becoming third largest hospital group in India. Creating a good bit of value if you come in and stay invested for 3 years as this merger happens, and then the synergy benefits plays through, and the valuation also gets a chance to get re-rated here. On the other side of the pharma space, we like CDMO companies. CDMO companies, we are seeing quite a bit of activity and healthy pipeline for the Indian CDMO companies from global, and this is irrespective of whether tariff happens or not in favor of India. China plus one story has been pretty much happening in the CDMO space. So we are interested in CDMO space and hospitals. Generic pharma, no. We actually had Cipla, which we exited recently because the earnings growth trajectory is pretty subdued in the generic pharma space. Even in the domestic pharma space, growth is decent, but will you really pay 30-40 times multiple for a 10% growth? That's a question that we are finding it difficult to justify.
Okay. Madan, last quick one. You spoke about NBFCs and you said particular names in NBFCs, and you've also had a tactical bet on MFI space. So what is the name over there? What should one look at right now?
I think in the previous episodes also we have discussed about some of the regional NBFCs becoming bigger over a 10-year period, like what happened with Sundaram Finance itself, our parent, how they have grown from a Tamil Nadu-oriented sort of business now to pan-India, and growing from, starting from vehicle finance, now moving into housing loans. So this is a very well-established model of growth and very successful model. And given what you have seen with Sundaram Finance creating wealth for the investors in the last 15 years, since the time I've joined Sundaram also, it's phenomenal. And you can't take eyes away of it, but you have to select the right names here. So when we look at it, Chola has done it well. Bajaj Finance, no need to mention about it. And of the other emerging names, we find Five-Star, Home First, sort of companies having similar attributes. They are looking at a long-term growth. They are building right kind of franchising, and they are starting from 2-3 states now and then becoming larger in other states, at least 10 to 12 states in India, where you can build a similar size of what you have built in the homegrown states. So this is a well-established, very clear structural model, and getting them early is very helpful. And that's the reason to stay with some of these NBFCs. Despite last year has not been great for NBFCs, recently they have pulled back pretty nicely with the noise around the unsecured loans coming down.
Sure.
On the MFI space, yes, it was a tactical bet, and we have gone into credit access recently. We hear that the NPA issues are getting resolved. It's not happening as quick as what you'd like to be, but I think first quarter to second quarter next year, most of it should be behind you. And valuations are reasonable in the space, and lack of competition and lack of capital will create value in MFI space for good players.
Okay. Okay, Madan, thank you so much for joining in with us on the show and giving us insight in terms of markets as well as sector-specific view. But on that note, we're going to slip into a very short break, and on the other side, we'll put the spotlight on stocks like Deepak Nitrite, Wellspun Corp that are buzzing in trade. So don't go anywhere.
Welcome back. On to some stocks that are moving around in today's trading session. And Cohance Life Sciences is also under pressure, among the top losers on the Nifty 500 in today's session after its fourth quarter results. Ekta is here to break the numbers down for us. Ekta.
Thanks for that. Well, yes, Cohance is in focus on account of its numbers. It was the first fully integrated quarter of, the entire merger of RA Chem, Avra, ZCL, Suvin Pharma, etc. So it was the first full integrated quarter with that. The revenue was at around 402 crores, but the margins dipped to around 18.3%, and the profit came in lower Q-on-Q as well as year-on-year. The CDMO Q4 revenue was up 31% year-on-year. This quarter. So that was basically, a bulk of the entire sales. Now, the company, however, said that FY25 was a year of transformation. They did improve on key business metrics. For example, phase 3 molecules went from 9 versus 2 earlier. And the RFPs have been from large innovator pharma companies as well. They've expanded their R&D team to around 500 plus. FY26, however, according to them, will be a year of acceleration and execution. Will be built by Pharma, CDMO specialty as well as API, specialty chemicals that is. This will put the building blocks for a $1 billion revenue target by 2030. So the guidance looks okay, but let's see whether it's, there's any kind of improvement in terms of the overall revenue. But this quarter was a lot of, the integration of multiple businesses, and hence maybe a little choppy.
Okay, thank you so much for that, Ekta. Keep an eye out on the stock Cohance as well. But let's move on to the next one. We have Avanti Feeds that's surging in trade after they reported a good set of numbers in Q4. Ria is here to tell us more about that. Ria.
Well, good morning. Let's take a look at how the numbers have panned out for Avanti Feeds in this quarter. For quarter 4, they've seen good growth in the overall revenue, up around 8% over the previous year. Very strong improvement on the profitability front as well. For quarter 4, EBITDA and net profit have jumped up by around 26% and 39% respectively. Even on a full year basis, EBITDA and net profit are up around 38% and 51% respectively on a year-on-year basis. Quarter 4 EBITDA margins have also seen a jump of around 267 basis points, with the full year margins going up by around 200 basis points compared to the previous year. Coming to the segments of the company, for the shrimp feed revenues for FY25, remember this constitutes around 78% of the total revenues. For this segment, the revenues have increased marginally, just about 3% over the previous year, but the EBIT margins have seen a very sharp jump up of around 500 basis points compared to the previous year. For the processed shrimp segment, though, this contributes around 21% of the total revenue. For this segment, the revenues have gone up by around 9%, but on the margin front, we've seen a very sharp decline of around 500 basis points over the previous year. And remember, the margins have been under pressure over the last year because of increased freight costs, higher raw material costs as well, and even the higher countervailing duties imposed by the US have caused some margin pressure for this segment. So this is one segment where the company has underperformed, but largely the results look very strong for Avanti Feeds, which is why the stock is trading higher today.
Indeed, good performance from Avanti Feeds showing up on the stock as well. The other one that's doing well for itself today is Deepak Nitrite, and that is after another better than expected quarterly performance. The margins were higher as well. The phenolics business drove the top line growth. Upasna is joining in with the fine print of Deepak Nitrite. Upasna.
Well, it's certainly a strong beat versus the street estimates. The recovery was seen sequentially as well, despite the geopolitical tension, elevated prices, and even oversupply from China. Mind you, Q3 was a subdued quarter, but in Q4, certainly the recovery is seen. Now, growth was driven by company's key segment, that is phenolics, which saw 5% revenue growth, and margins also saw an uptick of as high as 150 basis points. Now, overall, if we talk about the margins expanded due to mainly favorable product mix of the company, and this came in spite of pricing headwinds seen across the portfolio. Now, company says that it is seeing an initial signs of recovery in demand for products related to dyes, pigments, home and personal care, and even select pharma application products. Now, coming to their numbers for Q4 on a consolidated basis, revenue saw an uptick of 2%, EBITDA saw an uptick of 5%, EBITDA margin stood as high as 14.5% with an uptick of 30 basis points, while Street was estimating somewhere around 9.7%. So a big beat on the margins, and PAT saw a downtick of 20% at 202 crore, while the Street was working with an estimate of somewhere around 110 crores. Now, coming to the segments, key segment, that is phenolics, as mentioned earlier, saw a revenue uptick of 5%, and margins here stood at 15.6% with an uptick of 150 basis points. And next one is advanced intermediates. This saw revenue downtick of 2%, a bit of a subdued performance here because of the low volume is what the company has indicated, and margins here stood low at 7% versus 20% on a Y-on-Y basis. So overall, good set of numbers from Deepak Nitrite.
Overall, good set of numbers. We'll be waiting for those con call highlights that will be starting at 12 noon right now as well. So keep an eye on that. But let's move on to the next stock that is also buzzing in trade today, and that is Wellspun Corp. And this is after a good set of numbers that came in Q4 FY25. Nigel is here to give us details on this one and why is the street excited. Nigel, over to you.
Well, Wellspun Corp reported a very strong set of numbers, and the management commentary as well on the con call was very, very positive. So let's run you through a few pointers. The EBITDA per quarter came in at around 460 crores. And if you pull up with the last few quarters, well, we've not seen this sort of a number. So the EBITDA per quarter came in at the highest we've seen the last 5 quarters. And also it's close to a record high on a quarterly basis. So that was great news. Not just that, they're guiding that things will get even better from here on. So they've given their EBITDA guidance for the next year, which is at around 2,200 crores, which is very, very strong. But if you look at it, what they've done in the last 2 years, they've given a guidance, they've gone ahead and outbeaten that. Remember, the EBITDA guidance that they give includes the other income as well. But even if you go by the guidance that they've given in comparison to what they've achieved, that would mean an EBITDA growth of close to around 18%, which is very, very strong. Now, in terms of their balance sheet, things have looked up because they've sold some of their non-core assets, and now they're sitting on cash of close to around 5% of their market cap, which is good. They have a big capex plan of around 5,000 crores in the next few years, but they're generating cash and they have a clean balance sheet as well. The street likes that. And order visibility, it's very, very strong. They're sitting on an order book of around 19,500 crores, and they've got a lot of orders from the United States, which is a higher margin business. And because of the strong demand they're seeing in the United States, and because they have a plant in the United States, they're a potential beneficiary of higher usage of LSAW pipes. And that's why they're going ahead and setting up a greenfield facility as well. So they're saying that they have 30% market share out there in the United States, and things will only get better from here on. So put all this together, good set of numbers, good guidance, good order book, clean balance sheet. The street likes what they see.
Multiple positives for Wellspun Corp and 10% higher on the stock. The street rewarding the multiple positives that Nigel just highlighted. Take a short break. More on the markets on the other side. Welcome back. Quiet as of now on the index, still remaining at the flat line. And the broader markets, though, also the Nifty Bank, though, is a bit of a worry here. 220 points lower on that index. And that is what is keeping the index under check as of now on the monthly expiry day. Take a leave on Trading Hour from Vinny and me. Thank you so much for watching. Halftime report on the other side.